All right, guys, welcome back for another video. Well, there hasn't really been that much, price action in Bitcoin. I mean, Bitcoin's relatively been, within a range for the last few weeks or so. Nothing really significant going on. Of course, eventually after volatility contraction, you will see an expansion at some point. But you know, uh, I'm obviously positioned for that expansion to occur to the upside. I won't go through all the different rationale behind that. Just go back to some of my previous videos. But as you can see, I've got this position open right here, and just really kind of positioned for that expansion to play itself out to the upside. But I do want to follow up on the previous video I uploaded on the New York Fed and the credit swap line. So if you guys aren't familiar with the previous video I uploaded, go watch that. It goes into greater detail. But basically, what we're looking at is this central bank liquidity swap operation by the Federal Reserve Bank of New York. Basically, what I think is really interesting about this description here is that uh, they describe this operation as for the purpose of testing operational readiness. So to me, that gives me the impression that they're intending to scale up this operation pretty significantly, right? Why else would you be testing operational readiness if you weren't planning to scale it up, right? So you're testing the pipelines, make sure they work before you scale up the program. Now, right now, the transaction value is 6.5 billion in US dollar liquidity injected. You know, it's kind of amazing that is no longer amount that turns any eyes or raises any eyebrows. It used to be 10 years ago, but now you can just print 6.5 billion and nobody cares. It's just for print testing operational readiness. um, but just something to keep an eye on if it does expand into higher and higher numbers. I also want to talk about the Bank of England, and I haven't done a video on what happened with the Bank of England, and so I do need to put that in perspective. Basically, I'll start with the frame of the Bank of England started their tightening program 3 months before the Fed started their tightening program. So in a way, it the Bank of England kind of gives you a window into what will happen to these other central banks down the line, right? Because relatively, if you look at the British government to the U.S. government, they were highly leveraged, but similarly highly leveraged if you look at debt to GDP. So obviously, if you tighten into a highly leveraged scenario, you're going to have some type of crisis, some type of issue, whether it be in the sovereign debt market or the pension fund system. And in this instance, it was an issue with the pension funds that really caused the Bank of England to pivot. And not only did they pivot, but they pivoted like on a dime. They actually had a press conference scheduled the day they pivoted to talk about their tightening program and how they're going to continue tightening. And they canceled that press conference to print, hundreds of billions overnight, really. And that gives you an idea of like how quickly things can change because you kind of get this perspective that you know people have been listening to the Fed say for the better part of a year that they're going to keep going at it until the job's done. you know and who knows how long that will go, but I think the point here is that uh, when things do change, they can change very quickly. They can literally change on a dime. So it's important to be nimble in that sense because if you hear if you take the central bank as their projections as the word of God, and you hear them state the same thing over and over for a long period of time, that can kind of reinforce in your mind a element of certainty that just doesn't exist in the market, and it literally does not exist, right? These things can pivot very quickly. um, and anyway, so the pension fund system in England basically had a lot of hidden leverage derivatives embedded in the system, to the point where that yields were rising too fast, too quickly, and basically a lot of these pension funds were bankrupt. And the when the Bank of England realized that, they panicked and changed course extremely dramatically. Now, does every pension system and financial system have exactly the same type of embedded derivative risk? Probably not. But a lot of them do have some degree of embedded leverage derivative risk. And the reason for that is because of the inflation hurdle, right? As inflation increases, it pushes market actors out onto the risk spectrum. That's because they need to, you know, go further out on the risk spectrum in an attempt to maximize returns, to overcome the inflation hurdle to stay afloat. And that applies even to, you know, market actors who are not supposed to be considered risky investors, right? Like a pension fund or an insurance company. Your poster childs for quote unquote defensive investors. Even those actors, they still need to deal with the inflation hurdle, right? They need to overcome inflation just to stay afloat. So, again, it's just pushing people out on the risk spectrum and causes these embedded leverage issues and risk issues because, yeah, these entities need to deal with the inflation hurdle, but they're not allowed to publicly display themselves as taking risks. So it creates a scenario where they have to overcome the hurdle in a way where they're hiding the risk that they're actually taking, right? And that actually makes it more pernicious and more insidious because now you have all this risk in the system that is being hidden and covered, professionally covered, right? And so this is not out in the open, and when things are hidden like that, it's very difficult to manage risk. Now I know that's not exactly scientific, but it is a phenomena that plays out in the markets, right? And one element of that is that people are always looking back at the previous crisis to for the what's going to happen in the next crisis. So right now, like, everybody's looking for '08 to happen again, right? Ironically, the mortgage-backed security market is probably the one market that is least likely to have this embedded leverage risk in it, uh, precisely because it happened in '08, right? And there were so many regulations passed in the wake of that crisis that that's just not where the risk is, right? It's embedded in other systems. So unfortunately, it's like a game of whack-a-mole, where you almost have to have a crisis to get the regulations you need to prevent a crisis in the future. So while everybody's looking for another 2008 mortgage-backed security crisis, I'm pretty confident in saying that that is not what we're going to see at all, right? Like, people are always looking for the last thing that happened. Anyway, again, just understanding this is very very important to understand. And there's a little bit of a connection to Germany, right? If you look at what happened with yields in Bank of England or in England, sort of like in connection with what was going on politically at the time, and the type of political programs that were being advocated in England, are typically come around a new election cycle and promises of very loose fiscal policy and different both tax cuts and free programs and incentives and stimulus handed out. you know the bond market had none of that, right? It's just yields went very aggressively north in England. And so that's something to keep in mind for Germany. Whenever you see, like, I'm not really familiar with German election cycles, but whenever the next German election cycle is, That's really important to pay attention to, because you might see the same phenomena play out, right? You might see, you know, it's very popular politically to advocate loose money monetary policy. Like, it's a very good, effective policy to get elected. So you may see the next German, you know, government regime, whatever, do the same thing, and German yields react the same way, causing a similar crisis. But what makes it more significant is Germany is the centerpiece of Europe, right? So whereas, like, you have a crisis in England, it's relatively contained. In Germany, a German crisis would be much more pervasive, much more severe, and bring the entire continent down with it. Anyway, so how this kind of ties into the energy situation. Uh, so you know, again, Europe has an energy shortage, and Ukraine has an energy shortage as well. And now Russia is doing targeted strikes on their energy facilities. So you see this article saying Ukraine war, blackouts in thousands of towns and villages after Russia strikes. So, Russia is targeting Ukraine's energy infrastructure, and Ukraine already doesn't have enough energy to continue its war effort. And war is a endeavor that requires more energy than pretty much any endeavor else in the world. So it's unclear how they're going to secure the energy needs to fuel their war effort. I mean, America, all the richest energy producers are, in the global east, not the global west. Now, the United States does have relatively some amount of energy storages, but they're barely sufficient, and they definitely don't have enough to fuel the Ukraine war effort, to fight Russia on the battlefield. And they also don't have enough energy to fuel, uh, you know, even Europe's energy crisis, right? So Europe is in the midst of a crisis, both, from the war. Obviously, trade routes have broken down. The Nord Stream pipeline blew up, and America cannot print energy, right? You just can't do it, right? We have a finite amount of energy, and you know it barely encompasses our own energy needs, and you can't print the difference, right? We don't have enough energy to supply Ukraine and Europe with their energy needs. So, but what we do have is we do have an unlimited supply of dollars, right? And while you can't print energy with dollars, a lot of global trade is denominated in dollars. Or excuse me, a lot of global energy trade is denominated in dollars. Um, so to some degree, you know, dollars are still a derivative of the price of energy, and you know, to the extent that a certain huge percentage of global energy trade is denominated in dollars, is the extent that you can print energy with your ability to print dollars. So now again, that's kind of fading a little bit. Um, you know, a lot of not a lot, but some trade is moving away from dollar denominated energy trade. But the dollar is still a significant. It is denominating most global energy trade still to this day. Um, if you ever see that change, that would very significantly impact the fundamental value proposition of the dollar. If it's and something to keep an eye out for. But still right now, uh, we we can't print energy, or America. I say we, but I'm an American. Americans can't print energy. We can print the next closest thing, dollars that people can use to buy energy, and that's what we're paying attention to with this central bank liquidity swap operations, right? Uh, you know, the U.S. Tapped on the shoulder by the U.S. Treasury, because the Federal Reserve is no longer an independent entity, right? They're beholden to the government. They're an arm of the government, and they can be tapped on the shoulder by the U.S. Treasury to say, "Hey, there's this geopolitical crisis brewing in Europe. We need you to inject liquidity into the ECB and Swiss National Bank." And that's exactly what they're doing right now, and testing this program for operational readiness. Are they ready to scale up? I mean, to what degree will they scale up? It's hard to say for sure, but the thing that is for sure is that the Federal Reserve is getting ready to inject liquidity into Europe, right? And the reason why is not a huge mystery. I mean, you can put the puzzle pieces together. Anyway, I do hope you guys like this video. Uh, if you do like this content, please make sure to subscribe to the channel and stay tuned for more uploads.